On Fast Money, they frequently play a game called Would You Rather. We're going to talk about that, look back on a couple of names I've mentioned recently on live streams, and take a peek at Palantir and Amazon ahead of earnings today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where you can choose the topic and we can examine it together. Before I get to your comments in the chat, though, I wanted to talk a little bit about pairs trading. Pairs trading is a market-neutral trading strategy that involves simultaneously buying one asset, such as a stock, and selling another related asset. And the idea is to take advantage of the relative price movements between two highly correlated assets. So if we're looking at stocks, those would typically be stocks within the same sector, or even maybe more specifically, the same industry. These securities, though, can be stocks or commodities or even currencies. The two securities are chosen because they usually move in tandem due to their relationship. For example, two companies in the same sector, like Ford and General Motors, may be highly correlated. Over time, though, there may be a divergence or spread in their prices. In pairs trading, a trader may bet that the divergence is temporary and that the prices will converge again, or alternatively, an investor may observe that one company within an industry is likely to outperform one of their peers and may bet on the anticipated winner while shorting the anticipated loser. Since you're betting on both the long and the short sides, the strategy is not dependent on the broader market going up or down, making it more resistant to market volatility. Now, during recent live streams, I've spoken about 4 different companies, and 2 represented potential pairs trades where I may have actually even played that fast money game, Would You Rather. In at least one instance, it was prompted by a question by one of you watching, Elf versus Estee Lauder. But I don't think I actually outlined pairs trading at the time. Understanding pairs trading helps us as investors because it helps provide some perspective in terms of valuation. It basically takes comps analysis one step further. At the very least, this might help determine whether or when to purchase or sell a holding. But if you actually effected the trade as a pair, you can hedge against market volatility. And since the strategy focuses on the relationship between the two securities rather than the overall market direction. And this makes it a more stable strategy in volatile markets, which we seem to be starting to experience now. And since the positions involve both a long and a short, the risk of large losses is typically reduced because the gains in one trade are often offset by the losses in the other. And it is a method where you can exploit or capitalize on temporary inefficiencies in the market or on basically longer-term fundamental bets that you might be making. So some things to think about. It's helpful if you have some sector-specific expertise. If you understand a sector better, like technology or energy, or in the case of Elf versus Estee Lauder, cosmetics, obviously, that's going to enhance your ability to make profitable trades in this area. The other nice thing about this is that you can also diversify a little bit. You can take market neutral pairs in a variety of different stocks and diversify your portfolio with that and not make it totally dependent, again, on the overall market performance. Now, there are more sophisticated techniques for pairs trading, and I want to distinguish what we're going to be talking about with those. More advanced traders often are taking a look at very specific quantifiable correlations. And in that case, they're often taking a look at a massive amount of data in real time, and it requires sophisticated data analysis and statistical modeling techniques and close monitoring of the trades. And that is obviously very difficult. That's the kind of thing that Renaissance Technologies does. That's not really what we're talking about here. So the reason I bring this up is because the question that we had gotten was essentially a would you rather Elf Beauty, ticker ELF, or Estee Lauder. And I wanted to go back first to the fundamental difference between the two, because I think this is true for Elf versus Estee Lauder. I think it's true for Lululemon and Owen Holdings and Nike. To a degree, it might be true for Starbucks and Chipotle. Now, I realize those are not directly competing, but the CEO of Chipotle went to Starbucks, and you have two restaurants effectively that are experiencing very different things. And so I thought we should take a little bit of time to examine what some of this might look like. So let's start with Estee Lauder and Elf first, because the question that was proposed at the time was, would you rather be long Elf Beauty or would you rather be long Estee Lauder? And my question at the time was e.l.f. Beauty. Why did I say that? And how would one affect a pairs trade if that was the way that you decided to make this bet, so that you didn't have to take direct market exposure in the event that both started to turn lower, which, as it happens, both have been lately. So what I was taking a look at, and if you see on my screen, I'm not sure if you can, this is Estee Lauder. And what we're going to see here, along this top here, if my cursor is showing it, this is the top line for Estee Lauder. We can see that for the fiscal year ended June 30th of 2022, they had about $17.7 billion in revenues. That has fallen to $15.6 billion. So a pretty significant fall off in the intervening period for that ended June 30th of this year. So compare and contrast that then with the same period effectively for e.l.f., which conveniently we have at least the last 12 months here. We would actually need to make a slight quarterly adjustment, and I think I did that on that earlier live stream. But what you can see is that here you have a company that is growing at a very fast pace, right? So in round numbers, you've got a business that has more than tripled their top line versus one that has been declining. And why this is interesting is because if you take a look at the forward estimates for both of these companies, as it happens, both are trading at relatively close multiples to one another in terms of their turn to forward earnings. So I'm going to put that up here. Well, bear with me while I just get rid of some of this superfluous stuff. There we go. Okay. So we've got e.l.f. on the top. e.l.f. is trading at 30.3 times forward earnings and growing. And we've got Estee Lauder on the bottom, which is trading at 31.8 times and has been shrinking. Now, we can take two things away from this. One of them is clearly that if the market is valuing these two companies at very similar multiples, then presumably they have access to the same information we do. They might be expecting that for some reason, Estee Lauder can return to growth, and perhaps that e.l.f. Beauty's growth is going to slow. That's the only reason you could potentially justify having these two stocks trading essentially at the same multiple. If you believe that e.l.f. is going to continue to outperform Estee Lauder, even if not by as significant a degree as it has more recently, you absolutely would prefer to own e.l.f. over Estee Lauder at the current valuations. So how would one go about doing that trade, and how would a trade like that have performed over time? Now, I want to give some credit to my former colleague, boss from Ivory Capital, Andrew Shirley. I'm only mentioning him because he happened to send me a message on the terminal earlier today, and I rather liked what he had to say about it. But his comment was, $4 in EPS for e.l.f. is inevitable, and $4 in EPS for Estee Lauder is impossible. And I told him that when he mentioned that, I rather wish I'd thought of it myself. I thought that was kind of an interesting way to frame it. But this is the way a trade like that might look. You would purchase dollar for dollar. You could do it this dollar for dollar. Now, some people will adjust these a little bit for volatility, and in other cases, people will adjust them because you would create some periodic rebalancing that has to occur, right? So if you bought $10,000 worth of e.l.f. Beauty and sold $10,000 worth of Estee Lauder, and the trade actually started to work out, then what would happen is that over the course of time, the scale of each position relative to each other would no longer be quite right. So you could either buy a little bit of Estee Lauder as it dipped. You'd have to sell more Estee Lauder as it dipped, or you could close out some of your e.l.f. gains in this case. So in this particular chart, the one on the bottom that I'm showing here is the relative relationship. So this is a one-year trade. Had you just done it one up, so bought $10,000 worth of e.l.f., sold $10,000 worth of Estee Lauder, and done nothing else, then you would be up. So you'd have had a market neutral strategy effectively for a 12-month period. You would be up $3,200 over the last 12 months on that trade, 32%. That's what this differential represents. And by the way, the valuation differences that I was just highlighting are the valuation differences as of right now. So even though that trade has shown a profit of about 32% on a market neutral basis, unadjusted over the course of the last 12 months, I still think there's more in it because the fundamental driver remains somewhat intact. Now, if you take a look at the prices, you can see that they are somewhat related to one another, but not perfectly. But in effect, this is what you do. So you can also imagine, though, that if, let's just say, you rebalanced it monthly, or you rebalanced it quarterly, or maybe you set some threshold, at this point right over here, so at one point that trade would have yielded a huge difference, right? So at this point it was over 100% return on a market neutral bet. It's very unlikely, though, that anybody who is in this position would have held it on that scale at that time, because effectively what that means is you would have been long more than twice as much e.l.f. Beauty as you were short Estee Lauder against it. So, presumably you would have done at least some rebalance during that time. So one of the reasons I bring this up is not just because I'm suggesting, okay, everybody should go out and buy e.l.f. Beauty and short Estee Lauder, although I think it's probably an okay trade. The reason is because I think we should endeavor, whenever we look at any stock, to try to say, okay, because it's, we look at a chart, we think about the fundamentals, we compare it to the market, try also to compare it to their immediate peers. So that's comps analysis, very common in any type of trading decision-making or investment decision-making. But when you force yourself into which one, gun to my head, what do you buy? What do you sell against it? It does sort of clarify one's thinking somewhat. Now, I mention this because there are some other companies we can look at in a similar vein. And I think I've mentioned this on the live stream. I know I mentioned on Fast Money, it could have been about a month ago. I'm not sure exactly when I did, but many of you will know that Lululemon has long been on what I call the Holly Index. The Holly Index, for those who are joining us today who don't know what that is, probably about 10 years ago, I began, especially when it came to consumer discretionary stocks, because I'm not a shopper. I don't go out and buy stuff for myself very often. You get to a certain age, you just don't care about those things all that much. Not as much as my kids do, not as much as my wife do. So when I'm trying to get a sense of what people care about, I would just take a look at what they were spending the money on, right? So names that showed up on the Holly Index were Lululemon, Tesla obviously was a big one. That's, so I sort of weighted it by how much money was being spent. Apple appeared on there. And Nike was a big one for my wife and for my kids for a number of years, but not so much starting about 2 years ago. So about 2 years ago, my wife started buying ON shoes. I had never heard of them. She bought me a pair for Christmas. I'm actually use them as tennis shoes now. That's ticker ONON. We're talking about ON Holdings. And what is interesting about this is that if you take a look and we do the same kind of analysis, right, what we're going to see is that ON Holdings is growing the top line at a double-digit pace, 25+%. And meanwhile, Nike, which had been something that the kids cared a lot about, so consequently we spent a lot of money on Nike products, has not been going in that direction. In fact, it's been going in the opposite direction. It has been going down. And lo and behold, if we take a look at the same thing that we were just doing and we substitute ON Holdings, and I'm just going to normalize this so that we can kind of assume we get a very sort of similar picture. And in her case, she started buying these shoes about 2 years ago. I think she bought me my first pair. Maybe it was not this most recent Christmas, but maybe the one before. And, we can see this kind of relative outperformance thing going on. which is significant. Now, in this particular case, had you simply bought ON Holdings, that would have been fine. But I bring up this pairs trading thing now because if the market does start to chop around, we talked on Monday a little bit about the fact that some banks, including Goldman Sachs and JP Morgan, are forecasting slower total returns, or lower total returns, I should arguably say, for the S&P over the course of the next 10 years. In that case, then doing these types of trades might be of greater interest. And you can see here that the outperformance trade, so doing this as a pair, actually made more money than simply buying. ON Holdings is a huge winner. The thing's up 180% in 2 years. You actually be up close to 190% had you done it as a pairs, though, because Nike is actually a little bit lower. So what does this require? Well, you can do this, of course, with options. I'm really talking about longer term trends. ELF versus Estee Lauder, this is a multi-year thing that's playing out. And it's probably going to take some time for this to continue to play out. We're going to wait and get more quarterly earnings results and see how it goes. But this is the kind of thing where if you've got one company that's growing at 25% and another one that's shrinking by 5 to 7% per year, then the multiples for those two companies should be wildly different, right? So arguably 30 times earnings for a company that's growing earnings by about that pace, or maybe even a little bit more, and is growing the top line by close to 30%. That makes a lot of sense. It makes even more sense when you figure that the S&P is trading 25, 26 times earnings and not growing anywhere near as fast. But if you're concerned about the industry, concerned about the space, concerned about consumer discretionary spending, the way you can take advantage of that is you can say, okay, fine, I'm going to buy ELF and sell Estee one up against it, but be prepared to take some time for that trade. So the other thing you would obviously need to have the capability to do would be to short stocks, if you're going to do it that way, or just repeatedly roll a long options position and a long ELF, short Estee options position over time. And the other thing I would say is that because you're going to be doing this over a prolonged period, if you're using options strategies, you don't typically want to use ones that have a lot of decay, because that's just going to be a headwind on both sides. So buying call options in ELF and buying put options in Estee Lauder is not the way to do that trade. Maybe you could do call spread risk reversals in ELF, and maybe just be short Estee Lauder against it. Of course, some people don't like to do that. So you could also do some kind of zero cost, sort of in the money put spreads. So you essentially limit your risk. And let me just come up with a quick example of what I'm talking about there, because it is possible to make a directionally short bet on a stock using a debit put spread that is in the money, and what you're going to be accomplishing with that is minimizing the decay. So we'll just, and I'm not targeting anything specific, I'm just using this by way of example. But so here we have a 90-70 put spread. It is trading at somewhat in the money, but if you take a look at this trade, okay, it's $6.75. It's only $2.20 in the money. So that definitely has some decay to it. So you can modify that trade and choose something that is somewhat deeper in the money. Now, this is very different than what I frequently talk about, because generally when I talk about options trades going into catalyst, one of the things I want to achieve is convexity, but that's not necessarily the case here. So in an instance like this, what I'm actually looking to achieve is a way to be short the stock but also cap my potential risk, right? And so here we're talking about, now this thing is more than $7 in the money, $7 worth of intrinsic value, right? Because the 95 strike put is $7.20 above the, actually not 7, Yeah, $7.20 above the closing price of 87.80. So your total decay on this trade, which goes out to December 20th, would only be about 20 cents. Okay. All right. So I just wanted to go back and touch on that a little bit because I don't think I had really, although I had compared these companies, I don't know that I had actually talked more about that whole pairs trading concept. And I wanted to bring the pairs trading concept up particularly now because on Monday I kind of left it at the market's valuation is awfully rich. We face a lot of potential headwinds. All of those are challenges. And one could be left thinking, okay, that leaves us with nothing to do then. How do we deploy capital in a market like that? And I want to leave everybody with the idea that, no, you don't, that's not the case. You just need to start minimizing how much overall long market exposure you take when you're looking at opportunities like this. Okay, so with that, I think we can move on. We received, I think, let me see if I can find it. I'm going to bring up I think I forgot to launch my social media thing here. I monetized the SPY hedge I had for the election. Okay, so that's a good one. Monetized a SPY hedge for the election cycle. Yeah, I don't think the need for hedging is over. Okay, so let's be very clear about that. What the market has done so far is obviously sell off a little bit from its peak. But look at that. I mean, that's a pretty mild pullback. The high was almost 5,900. A correction would be a 590-point drawdown from there. So what we're talking about then is taking, we'll just call it 600 to keep things easy. That takes the S&P to 5,300. That's over here, by the way, right? That's right down to the 200-day. A bear market would be a 20% decline off the high. So now we're looking at 1,100 points, 1,200 points-ish from there. 1,100 points off of 5,900 gets us to 4,800. That's down here where my cursor is, if you can see it. So do I think we don't need hedges now that we've had this minor little pullback? I don't know that actually the market has even pulled back to the levels it was when I initially recommended that it might not be a bad idea to be hedged going through the election, despite the fact that you will often hear people say that election years tend to see outperformance. It's a really small sample. I said that then, I'm going to repeat it now. Elections only happen every 4 years. We don't have that much data. And in many instances, we had foregone conclusions or other extenuating circumstances, or maybe not that much uncertainty about what was going to happen going into the election. I think there's a little bit more uncertainty here than, for example, when FDR was running for re-election. Not that FDR and World War II era markets are necessarily a close proxy for the one that we're finding ourselves in now, but I think you get my point. We're dealing with relatively limited sets of data if we go back to 1930 and then start taking a look at presidential elections since that time. So I would encourage folks to continue to think about hedging into the election. So one of the questions we got, what about Palantir? That was one of the questions that we got right before I had to end the last one because we had gone basically for a full hour. I just wanted to show you this chart. I thought this was kind of interesting. If one ever worries about or thinks about double tops, maybe it's worth thinking about here. If you think about things like valuation, something like price to sales, we can go back and take a look at that. Here too, obviously at a relatively high level. I say price to sales because the company is growing quickly, and I would expect, so when companies are growing quickly, one of the things you'll often start to see, and we definitely saw this in the case of NVIDIA, for example, that, and also Netflix, right? So the top line starts to grow, and expenses are growing alongside, but at a certain point there's a divergence and margins start widening out. So simply taking a look at the top line growth doesn't necessarily, you cannot extrapolate earnings growth from top line growth necessarily if you expect margin expansion. So the relatively high multiple that we have for Palantir at the moment, and right now the street's looking for 36 cents a share full year, 43 for the next year. So 43 is a nice round number. It gives us 100 times next year's earnings. And we're dealing with 20% top line growth. So is it possible that we could get better earnings than that? Well, I think it is possible. But I do think that the valuation's a little bit rich. I'm looking at that potential double top. So those are two things that have me concerned about Palantir. Bearing in mind that in the interest of disclosure that, one of the aforementioned institutional investors that I have as much respect for as anybody happens to be long that stock right here and now, although he admits that he might start pairing it at some point. Look, it's a great growth story. And there's one other thing. I don't know if I've shown you guys this chart before. So this basically shows a company, who they sell to, who they buy from, and who they compete with. And I think it's a very helpful chart. Kind of hard to read, I realize. But one of the things I want to highlight here is the companies, or institutions, I should maybe say more accurately, that Palantir sells into. So here we have Great Britain, their Department of Defense. Down here you have our Department of Defense and various divisions of it, right? I bring this up because obviously in some ways there's no better customer than one that doesn't seem to know how to control its own spending. If they think they need it, they're going to buy it. So that's the good news. They have a lot of government customers, and they are selling products into them related to data, which is arguably the most important thing for everybody right now. So I think that is probably the biggest reason why we see valuations as heady as the ones we have, right? So just taking a look at earnings, which they are scheduled to report the week of the election. So according to Bloomberg, at least, that estimate is for November 4th, and I can actually confirm what they have on their website. Let's just double check that. Let's see. Okay. So earnings release, what do we got here? Does not look like they actually have formally confirmed that yet. But it does stand to reason. They reported their last earnings on August 5th. So it's very likely going to be that week. We can probably look out to those weekly options and see what's what. We'll just basically, to keep things, we'll say it's about 2 weeks out, and we'll just take a quick peek at what that costs. So the November 8th straddle, $43 stock, 310, 320, call it, we'll pick something in the middle, 325 and 310, right? So 635. So that's $6.35, mean absolute deviation anticipated over $43, or about 15% of the current stock price. And we can compare that to how the stock has typically moved in the past over comparable periods of time. So here we are about 14 days prior, give it 2 days after. And the absolute average price move has been about 20% over comparable windows of time over the longer term. The last two, not nearly as big. But again, it kind of suggests to me that options are probably somewhat fairly priced here. If one's inclined to make a directional bet, own the stock. Maybe you want to buy a put spread in it. Just a thought. especially if you're concerned about that potential double top there. The other thing you could do is a stock replacement strategy. And what you would do if you're going to be in a... okay, actually, so I'm just seeing we do... Okay, yeah, here we are. Something on the Business Wire. Yeah, November 4th. So that actually does confirm that Bloomberg's data is correct. So, another thing you can do in circumstances like this, somebody was talking to me about how you choose option strikes when you're using them for a potential catalyst. And one thing to think about is, what are the potential outcomes we're thinking about? Right? So in Palantir's case, I see potential for a double top here. I don't know whether you happen to agree with that or not. So if you're making the bull case, what is the bull case? The bull case is that the stock is going to break out above that range, which conveniently enough is pretty much $45 to the penny, as Carter Worth likes to say. So if we're going to look at that, then the options trade that you would be considering if you believed it was going to break out would have to be something that would capitalize on a move of that magnitude. You don't need to have a whole lot of participation below that level if that's your thesis. So we're going to take a look at this both ways. One is you're assuming maybe I own the stock and I don't think it's going to break out at that level. So I've got the stock. We'll just add, we'll just do this. So let's say you own the stock. We're looking out to November. I'm going to use regular way November, even though that we know that earnings is going to be before that. But one thing you could do to protect it is say, I don't think it's going to break out, so I'm actually just going to sell that 45 strike call. I don't think it's going to exceed that. That's the top, the previous top. So I'm going to sell that 45 call and then buy a put spread to ensure my position. And I don't need to be quite at that price. Maybe I could pick like the 41.5s and sell something down here against it, right? Like this. So that basically gives you participation up to that top. But the truth is that if you believe it's going to get to that top and fail, I almost wonder why you would have a position like this on, rather than saying, I'm going to take the money off the table in the stock and maybe just buy an upside call option to play in the off chance. What I am forecasting is the unlikely chance that it actually breaks out to new all-time highs. And, by the way, I want to point out, this is not, from a fundamental standpoint, as I was previously saying, things are working for this business. But the valuation it's just really, really tough. And when you combine that with the technical setup, it gets even tougher. So if I own the stock, and I do not, then I would probably just be selling the stock here and saying, you know what, I'll buy a November 45 call, and if it blows out to new highs, then I'll get to participate that way. You're going to be risking 5% of this current stock price or something like that. That would be my take for Palantir. Okay. So I think somebody else was also, what we got here? So Joseph Kamen says, I made a bad trade. I bought a Jan 17th 550 put some months ago for 20. Now it's now worth 783. Should I take the loss or wait and see if the trade improves? Bought it as insurance. Well, first things first, I would say if it was insurance, has the need for your insurance gone down? I suspect not. The downside, of course, now is that it is... Here's one way I like to describe it sometimes. If you buy a put, let's say you've got a stock that's trading at 100 and you buy a 95 strike put, the premium that you the deductible is the difference between the strike and the current stock price. And then, of course, the premium is a premium, right? So if I own the 95 strike put, the stock's trading 100, then, essentially I have a $5 deductible. The problem is that if you bought that 550 put when the SPY was trading much closer to that number, now we're trading closer to 580. Well, essentially you've got a bigger deductible. Your premium is less, what you have left to spend of it, of course. So kind of think about what you had out there as a sunk cost, because if you bought it as insurance, that's what it is. You paid the premium. What is that premium? It's about $8 now, so you spent $12 to have insurance between whenever it is that you bought it and where it is now. But it is worth thinking about whether you would be interested in resetting that. I generally prefer, for some of these insurance trades, to see people using put spreads rather than just outright puts. Couple of reasons for this. One is, although this hasn't been as much true this year, I've said this a couple of times, but over a longer course of history, it's demonstrable that index options premiums are overpriced, meaning that the implied volatility for index options has pretty consistently exceeded what the realized volatility was. This is less clear in single stocks, and it's also harder to simply make a generalization because single stocks have more identifiable catalysts, like the 4 earnings that they're going to report each year. But one thing you could consider doing if you were concerned about, number one, not having the kind of exposure that you had before in terms of getting that immediate downside protection, but also the fact that you sunk $1,200 in premium for every one of those puts that you owned, what might you do? So, well, let's just start by taking the option that you currently hold, which is the January, I assume it's the regular way 550s. I think you put that in there. Jan 17. Yep. Okay. So you had these things. Well, look at that. 783. So that's the dead mid for those. Okay. So now I know I've got the right one. So what can you do? Well, one thing you could do is replace that with a put spread, which will have slightly lower rates of decay, or at least for spending the same amount of premium, give you insurance that kicks in a little bit sooner. And then compare these two positions to one another, right? So we could look to buy a January put spread and lay out a very comparable amount of premium, but choose higher strikes to do it. So, for example, if I bought a 580 put spread and spent $15 and then sold the one you actually own, which is the 550, okay? So now you're about $7.40 of premium in that trade. You have $30 worth of participation. Think about where the downside, at what point would having this spread actually have been a worse turnout for you than owning the 550s? Well, of course, the profits on this are going to be capped at the downside strike where your other protection is actually going to kick in. But don't forget that what's going on here is you will have realized those profits at 550 where the other one would not yet be profitable. And so it actually has to decline significantly more before you get to that point. And perhaps one of the things we can do is just simply illustrate this way. Okay? Okay. Yes, Bob, I see, is asking about Palantir. Yeah, we were just talking about that. So, you can stick around for the things we're talking about now. But when we're done, if you want to go back, we were talking about Palantir only a moment ago. Okay, so let's just take a look at this for a second. Okay, so we're just going to say here's the price of SPY, and let's just take a look at the value of these different options, and then see where one would actually exceed the value of the other. So in this case, we have a 550 put and a 580 put, and we'll just run SPY from well, we'll go 500, and we'll go in $5 increments because I think you guys will get the point. Don't need to make this into too big a thing, really. So we are right around here right now. and we're just going to take a look at the value of each of these options. Oops, what did I do there? 0, B string, did I do that correctly? B string 2, minus, oops, no I didn't. That should be a 3. There we go. Okay. All right, so now we're going to just quickly take a look at, I'm just going to just compare and contrast the value of these two trades relative to each other. So we're going to pay $7.40 for the put spread. You own that 550 put at 783. Okay, so we're just going to create the P&L for each of these. So this is going to be equal, the value of the put spread is going to be equal to this minus that minus D string 2. And this trade is simply going to be equal to that minus E string 2. So now we get to see essentially where the difference is and see where one outperforms the other. So the long put that you currently hold is going to outperform in these areas. Okay? Now, you can see that the break point in this is about 520 in January. Okay? So I'm just going to plot the difference in these two so we can sort of, and what you can see is that, and I should probably just add so that we can get a sense of it, but this break point over here is down around 520. Okay? And SPY's closing price today was 578. So that's a market correction. That's a formal market correction that is necessary. You need to get a correction at least before the 550 outrights will outperform the put spread. And if I wanted to, you could, of course, you could say, all right, well, maybe I want a little bit more bang for the buck. So you could actually choose something like a 575 and take this down a little further. 575, 525. Take a look at what that costs. And you get something like that. Costs $8.77. So only $1 more than your 550 outrights. And you can imagine that that break point is going to move much further down. So you're going to see profits sooner, and it's going to take a significant amount of time before the benefit of owning the outright put is going to outweigh the P&L kicking in at such a higher level on that put spread. So generally speaking, I favor put spreads on indices. And the other reason that I favor them is simply because of skew, right? So skew being the relationship of the implied volatility of the downside puts to the at-the-money puts and so on. We'll just look at January right here and now, and we're going to go to that specific expiration. Get rid of this. So we're only looking at this one. And here's what you're looking at, right? So you buy an at-the-money put or something close to it, you're buying something like this. You sell a 10% out of the money put, like the 525s-ish, right? That's the implied volatility you're selling. So it's significantly higher. And that creates a circumstance where you end up with payoffs that aren't unattractive. That's a $50 put spread. Costs about $8.50 to put it on. So you're getting a payoff of better than 4-to-1. Yeah, I might prefer to do it. I might prefer to do it that way. So you're spending a comparable amount of premium. You're still getting some insurance. It's only partial insurance. So if we get a 20% drawdown in the market, it's not going to insure against a bear market over the course of the next couple of months, 3 months, right? a little less maybe. But it's certainly going to mute the pain considerably. And we're talking about comparable costs. So just, one other point. So if you happen to buy 30 delta puts as a hedge, like 1 month 30 delta puts, which is something that Goldman Sachs has long recommended, it's a strategy that, for at least 10 years I've heard a lot of people use, because many years ago they said, the best way to get downside hedge is to, say, buy a 30 delta put. Something to think about. If you do that and the market pulls back, roll or spread so that you can monetize some of that. Because another mistake that people can make on that hedge is, well, what are you going to do? Are you just simply going to wear it, and then the market declines and you do nothing, and this put spread increases in value and goes up and up and up, and then the market bounces back and then you give it all back? No, the idea is that, and with a put spread, you're much more likely to monetize it. And the reason is that if it falls 10%, most of the potential value of that put spread is going to have been realized already. If you get down to 525 in SPY or 5200, 5250 or whatever in the S&P, you're going to be in a situation where you're actually compelled to do something. You should still do it if you were long a 30 delta put, but in the put spread, you really want to make sure that you're doing something, because you have very little to gain by continue to holding it. So at that point, you would take some of the money off the table, deploy a portion of it to potentially, a reset and buying a further out of the money put spread. And if the market bounces back, you monetize some of it. And the hedge did its job. It muted volatility, gave you some money in the meantime. And if it bounces all the way back to where we are right now, where the market will have provided nothing but dividends, you will actually have come out ahead. So that's another important point I would make. Finn West, good morning, Mike. Go Tesla. Yeah, long-time Holly Index name. We will see. We will see. It definitely feels like, well, first of all, this California Coastal Commission thing where he started a lawsuit because they were going to deny their, in this case it was SpaceX's application for more launches at Vandenberg, based on his political leanings. It demonstrates how fraught I think we are right now. It's not really a part of the conversation. I had somebody reach out to me on Twitter today. It was actually about Lululemon and Nike, incidentally. And they were making a point about the valuations. How is it possible that Lululemon is trading at a discount valuation-wise? Lulu's growing, so let's take a look at their multiple. They're growing the top line and the bottom line. So let's just do the bottom line. Okay, so here we have 5 years. Is this about 5 years worth of data? Should be. I want 5 years worth of data. That's what I'm looking for. Okay, so we're just going to compare and contrast Nike and Lulu. If I already showed the screen, I apologize, but this is kind of in that political bent side of it. So here you've got, again, Nike trading 28 times, Lulu trading 20 times. Earnings for Lulu are growing, earnings for Nike are falling. And somebody sent me a tweet, and let me see if I can find it, just so I can make sure I have it correct. The comment that was made was something about, Nike is woke and Lulu's management was conservative or something. Let me see if I can find this. Here we are. So I happen to be talking about the fact that there's a big disconnect, and that to me, Lulu, Nike as a pair, I like long Lulu, short Nike. And then this tweet came back, and the tweet said, Lulu's founder is right-wing. Contrary to popular belief, most of Wall Street are Democrats. That's it. Now, if whoever sent me that tweet is watching this, I'm not, trying to poke fun or anything, but I simply responded to that by saying, it's true that Wall Street donates more to Democrats than Republicans overall. This is documented because they have to document it, right? But I'm not sure that that confirms your hypothesis, the hypothesis that more of Wall Street are Democrats than Republicans, although that would not surprise me. But, you know, if I'm dealing with when I think about Wall Street, I think about the people that I worked with and for and so on. We were working in New York and Los Angeles and San Francisco. Is that a function of finance? Is that a function of the political leanings of the socio-economic demographic groups that are part of that? I mean, does it matter tremendously whether somebody's in one industry versus another? If somebody told me that most were Democrats, yeah, it wouldn't surprise me if we took a poll, a show of hands of everybody I ever worked with on those trading floors. But, you know, one of those trading floors at Cantor Fitzgerald, which I worked at Cantor Fitzgerald in New York, probably 200 people on that floor. In Los Angeles, there was probably 50 at the Cantor office there. And we had a much smaller office at 345 California here in San Francisco. But, you know, I worked in all those locations from time to time. And Howard Lutnick is the CEO of Cantor Fitzgerald, and he is supporting Trump, as far as I know. I'm pretty sure. In fact, I think I saw a picture of Howard Lutnick and Elon Musk together. So he's a Republican. And by the way, does it matter? Bill Ackman's a Democrat, and he apparently is going to be voting for Trump. So I asked a follow-up question, which is, does it matter in the context of looking at a company like Lulu or Nike? Do we care that much about the political leanings of the company's management, or whether the company is actually saying anything political in nature? So as far as the latter is concerned, yeah, if they are making political statements, I object to that, right? It's not these companies are fiduciaries for their investors' capital. Their stakeholders, their principal stakeholders, are their investors, their employees, and their customers. And they should focus on that. And I would assume that all three of those categories I just mentioned include people of all political stripes. So they shouldn't be weighing into it. Some can't help themselves. When they do, they often pay a price for it because you alienate customers, or you alienate some employees, or maybe you alienate some investors. But I don't think, in my experience, that the folks that I've worked with spend a great deal of time dwelling on that stuff. They are looking at spreadsheets. They're looking at numbers. To the extent that they care, they might do something like take a look at how much Bud Light sales fell when they had their controversy that led to somewhat of a boycott, and whether or not it was material and long-lasting that they had lost their dominant position as the #1 beer brand in America. They didn't recover that yet, as far as I know, but then you have other companies like Target that faced a backlash of its own, and I think they have been able to put that behind them, and I hope they learned from that and will say, you know what, we're not going to wade into these things. I don't think it's their place to do it. So I just wanted to make that point, that because the implication that was then offered, the follow-up tweet I received was, in today's cancel culture, political bias could explain the valuation gap. Id est, Democrat-leaning analysts and portfolio managers are more optimistic about Nike and more negative on Lulu. So I'm going to address just that one bit without naming names, but saying only this, that I know a portfolio manager who is bullish on Lulu and bearish on Nike. And he's bullish on Lulu and bearish on Nike because he can buy Lulu at a valuation that is a significant discount to the valuation of Nike, and Lulu's growing and Nike isn't. And even if Lulu has a negative earnings surprise, which I actually think when you take a look at the multiples, we have to expect it, right? It's trading at a big discount to the market, let alone to Nike, but it's trading at 20 times when the market's trading 26 times. So clearly, the 9% EPS growth that is baked into analyst estimates is not baked into the price. So there's a disconnect between the forecast numbers and what investors truly believe. They truly don't believe you're going to get 9% EPS growth, because if they did, it wouldn't trade at 20 times. But going back to the political question, does it influence their optimism? The answer is absolutely not, because the guy that I was talking to about this is a Democrat, 100% a Democrat. He's got, he's definitely not in favor of Trump, and he is in favor of Lulu. I've never heard him mention the founder's political leanings, and I've never heard him mention anything about Nike's policies or political leanings either. It does not play into it. And it shouldn't, because portfolio managers, much like management of companies themselves, they also have stakeholders. They too are fiduciaries. They are also responsible to their investors. And they are supposed to be delivering them returns, not political beliefs. It doesn't play into that. Now, I want to just say one other thing about this, and actually I'm curious to hear whether anyone's kind of interested in this sort of thing or not. But we do pay attention to politics, and we do pay attention to economic policies. And, for those who say, you should just stick to financial analysis or to trading and things like this, you don't wade into these other territories. Well, we could have very strong opinions about it, of course, because we tend to look at a lot of numbers all day, and we can see the implications, and because of that, we tend to come from a place of data. That's just going to be part of it. And actually, I'll say this: it brought up a really interesting question. But I'm very interested to hear your respective views on this, because obviously, I expect that if we have lower taxes and more business-friendly environment, that all else equal, I expect the economy to do better, I expect faster economic growth, and I expect stocks to do better. That does not necessarily mean that some of the baggage that comes along with that is 100% acceptable to me either. But we can't ignore these things, right? So it is important that we take that into consideration. And there is something else. And this is, I'll just leave you guys with this, and you can do with it what you want. I was watching, I think J.D. Vance was on, it could have been CNN. I don't remember which show he was on. But he was on a show, and there was a conversation about illegal immigration. And this ties back to, following data and being, in the financial markets, believe me. And a comment was made where J.D. Vance suggested that part of the reason we have a housing crisis is because we've had so much illegal immigration. The suggestion being that if you have more people, you need more housing. I think that's kind of undeniable. The commentator responded by saying, but much of the housing stock, much of the new housing built in the United States is built by, I think it was in her words, undocumented immigrants. So that immediately, I was very curious to see whether this was a concept or an idea that was going to be followed up on more closely by anybody, or if anybody was going to examine the numbers. Because you may remember it was just a week ago or so that we were taking a look at whether or not one could do what Warren Buffett had suggested. What if there were 800 companies that paid $5 billion a year in taxes? Our problems are solved. Well, we showed that mathematically that doesn't work. So these were comments that I was just very curious that nobody decided to look at the math. We get about 1.5 million building permits. Let's pull this up. I think, so building permits, yeah, we're getting close to an hour, but these are just things to think about, right? So we actually can track building permits. We get and housing starts, and let me see if we get this. And so we get something in the neighborhood of, let's just take a look at for the 1.5, we're going to use round numbers, 1.5 million building permits a year, give or take. New housing, the actual housing starts is frequently a slightly lower number, but I don't actually even care that much. Let's just say that we'll make it the same number, 1.5 million, okay? So, as it also turns out, there's about 2.5 people per U.S. household on average. So if you get an influx of undocumented immigrants to the tune of about 7 million, then you can do a little bit of quick math and you say, okay, well, we need about 3 million more homes for that. Assuming that the number of people per house are, and of course, we're making a lot of simplifying assumptions here. Okay, so 3 million new houses. Now, the net shortfall of housing over the last several years has been calculated as somewhere between 4 and 7 million houses. And we clearly have, you can go do your own homework on how many undocumented immigrants we have in the country. Illegal, use the term that you feel is most appropriate. But what we're talking about are people that are here that, came in by means that was not legal. Even the most conservative estimate throws out at 11 million, and there are estimates that are considerably higher. Let's call it 15 million, and then simply say, okay, that's 5 million houses. Let's figure 3 people per house, 15 million people, that's 5 million housing. That is essentially the entire housing shortfall that we currently have in the United States. Now, what about the claim that they're building the housing? Well, there is significant evidence that the home building industry employs a significant number of undocumented immigrants. That number, depending on the source that you look at, has been estimated to be somewhere between 13 to the high 20s in terms of percentage of the entire labor force of home builders in the country. Let's take the higher of those numbers. Okay? Let's even round it up. Let's say that 30% of the people in the trade are undocumented. Well, then you can only give, of all of the new housing starts that we've had over, say, the last 2 or 3 years, they could only take credit for 30% of it because 70% of the labor are not. And I'm skewing that way on the high side because the estimates are actually between 13% and 27%. But let's just call it 30. So if you have, over a 2-year period, 3 million new homes built, they can take credit for 900,000. And if we're going to say that 900,000 homes holds 2.7 million people, but the immigration has been considerably higher than that, then the additional supply that they contribute is not offset by the additional housing that they've created. It's just a little bit of math, and these are numbers that we look at all the time as financial analysts because we care about it. These things, the data comes out regularly, so you look at it. You look at housing starts. You look at inventories. I think I just saw it, building permits, right? So we look at these things, and here we are, right? There's the numbers, and you do that kind of math, and you say, all right, whereabouts are we? And does this all add up? So just things to think about. I didn't do a bunch of really deep research on it, but it just struck me as interesting that people have these conversations without actually going and looking at the numbers and saying, okay, well, you make a suggestion that immigration is a net negative for home prices, and then somebody else says it's a net positive for home prices, which is correct. Well, we have data. We should be able to try to figure it out. And hopefully, if we do figure it out together, then we're going to get closer alignment on policy because people aren't just making things up out of whole cloth. Can you share your thoughts on FedEx, the bane of my existence, over the next few weeks? Yeah. So, I think I might need to roll that over to next week, partially because I've been yammering about building permits and housing starts, and whether or not we have positive or negative contributions. But I'd be very curious to hear your inputs on this. And we're not going to get earnings out of them because they're a relative late reporter just yet. But I will tell you that I've really struggled with FedEx over the years. I mean, I can remember my first most punishing trade in it, 6-figure dinger in a matter of minutes, about 13 years ago, I think it was. Anyway, yeah, not my favorite company to try and trade. But I will take a look at it, and we'll go over it together when we have this live stream again next week at 4:15 on Monday. Like, subscribe, notification bell, all those good things. Thank you very much for watching, and I look forward to seeing you next week.